afternoon. This is Rich Reynolds with Realtor Mortgage Strategies. Today I'm going to be covering Highland Mortgage's no payment bridge loan with debt reduction option. I'm going to go ahead and explain what it is, how it works, and go over a flyer, then go over some numbers as well. This video should not take that long. I'm going to go ahead and change the orientation of the screen so that you can see the documents. So this is the flyer for the Highland Mortgage bridge loan with no monthly payment option. This is as you can see, it's a co-branded flyer. I can co-brand it to all real estate agents or financial planners or whoever wants to co-brand it with me. So you have a loan on the current home that you own, your current mortgage, and you have found a home that you want to buy before you have sold your current home, and you need the equity in this home in order to bridge over to that home. So the way you can do that is you can get a no payment bridge loan. And you say, what is the big deal about the no payment? Well, the big deal is this. So a lot of folks, when you have the mortgage payment on this property and then you add the mortgage payment on that property, that's two mortgages. And you got to carry all of that against your debt to income, your monthly debt to income. Your max debt to income ratio on this loan is 45%. If you add a third loan for the bridge, that payment is going to potentially blow you up. So the solution is the Highland Mortgage bridge loan with no monthly payment. Well, you say, Rich, well, how do you do that? So this is how we do it. So you've got a current home value of $300,000 with a current equity of $150,000. Now our max loan to value is at 80%. So we're going to do a bridge loan for $90,000. By the way, the max bridge loan that we're able to do on any file is $250,000. The usable funds to you are going to be $85,165. So this is the trick for you. This is how we do it with no payment. So as part of the fees, we collect 2.5% of the amount of the bridge. That's why you can see you got $90,000 less that. You have some closing costs, and I'll go over all that in addition to the 2.5%. This 2.5% is put into an escrow account, similar to your real estate taxes and homeowners insurance. At that point, then every 30 days, we're going to pull that money out in order to cover that payment. It's good for 3 months, 90 days, and then the loan is paid off when the home is sold. If you need a second 90 days, we can do that as well. So that means there's no payment. So what you're going to do with this $85,000 here is you're going to take it and put down 10%, $40,000 on a $400,000 purchase price. Now you got a 30-year fixed mortgage at 10% down. You can use the additional monies if you have a credit score of 720. The consumer debt reduction option requires a credit score of 720. You can use those funds to pay down credit card debt, car loans, student loans, American Express bills, anything like that can help you lower your debt to income so you can do all of this at one time. One of the other great things about this is the average hold on these. Once the buyer has purchased the new home, the average buyer has sold and paid off their loan within 60 days. So it does move pretty quickly. Once again, minimum score is 700, max DTI is 45 for both loans, and the consumer debt reduction option requires a credit score of 720. So what this is going to do is it's also going to allow you to make an offer while you still own this home on this home with non-contingent. What that means is it's not contingent on you selling this house. And that's how most sellers want to take a contract. So I'm going to minimize this and go down and show you how the closing costs work. Sorry about this. So the appraised value is $300,000. The first mortgage is $150,000. So the max available financing available to the customer is going to be $90,000. We're going to take 80% loan to value less the $150,000, which is going to be $90,000. So the bridge loan amount is $90,000. The interest charge is $2,250. Now, if you pay off the loan before you get to 90 days, you get back any portion of those unused funds. It is prepaid interest, similar to a buy down. You don't have to pay it back if you pay the loan off. So we'll give that back to you. There's an underwriting fee of $500, an appraisal fee of $550. Georgia, if you're in Georgia, there's a Georgia residential mortgage fee of $10, title agent of $450, lender's title insurance of $330, and then recording, intangible, and doc stamps. Some of these fees, these bottom fees, are all based on the loan amount, so these can change. So on this bridge loan amount of $90,000, the total costs were $4,835, which leaves $85,000 for down payment and to pay other debt off. You can use all of it for your down payment. You can use all of it for your credit. Now, one other thing you can do, in this instance where this customer was paying down, had the large portion, so there's got $90,000. That's 80% loan to value. So they're going to have another $60,000 come back to them, less any closing costs when they close on that home. So what they can do, they can take those additional dollars, call the mortgage servicer, and request that the loan be recasted. So they'll send over whatever portion of that money to the servicer. They will accept that payment, apply it to principal, and then recast the loan so that the payment will go down even further and potentially get rid of the mortgage insurance. So if you have any questions about any of this information whatsoever, please give me a call. My name is, once again, it's Rich Reynolds. I'm the host of Realtor Mortgage Strategies. My number is 813-758-1389. You can reach me by email at rich.reynolds@highlandmtg.com. I appreciate you. Let me know if you have any questions. Thanks so much.